This is Scott Becker with the Becker Private Equity and Business Podcast. We're thrilled to visit today with Matt Wolf. Matt is one of the leaders at RSM, sort of the best mid-market private equity sort of advisor in the world. Great consulting, great seller due diligence, great quality of earnings. They've built this incredible practice there. Matt talks to us regularly about issues he's watching, trends he's watching. Today he called GDP Day because the GDP report came out for the first quarter today. Matt, why don't you take a moment and tell us what you're watching and what you're thinking?
Yeah, happy to. Thanks, Scott. As we're recording this, we got GDP and PCE a few hours ago, and there's obviously a lot of commentary and a lot of watchers on, all right, we had this sort of surprise miss on GDP growth. Our take there is that a lot of that was kind of obfuscated by volatility in inventories and exports, partially due to a strong dollar. Q1 GDP is typically revised up. The number looks big in terms of the miss, the 1.6 compared to the 2.5% consensus estimate, but as you sort of look at the components of it, you look below the headline. I don't know that it's quite the cause for alarm that some pundits on the financial news are claiming. But time will tell, of course. Inflation remained sort of sticky where it is, and that also caused a lot of sort of the real GDP to be a little bit obfuscated. We're seeing markets are really kind of going closer to this, maybe 2 cuts this year in September and December is sort of the overall market consensus with which we typically agree, and that's all important. But the conversations that we're having, the way that we're looking at this, and what we're sort of advising is that as we move into this regime of actual positive real interest rates, which largely did not exist, or at least was not persistent for the period between the end of the global financial crisis and the sort of March 2022 interest rate hike campaign, where we had very low or even negative real interest rates. Now we're into this more normal economic regime where, yes, maybe monetary policy is still important. However, it's not as important as it was back when interest rates were low, right? It's just not. Things that are more important now and going forward over the near to medium term, perhaps even to the long term, are things like inflation, are things like fiscal policy, and those are going to affect different ecosystems, different subsectors of businesses differently and at different times, right? So, you look at, and we're already seeing evidence of that, right? Look what's going on in manufacturing compared to what's going on in big tech. We no longer have this sort of binary event, winner takes most sort of economic outcomes that are pure or almost primarily driven by monetary policy. It's become much more complicated than that. And so while it's important, I think, for investors and for executives, for leaders, for others, to look and pay attention to what is happening with headline GDP, what's going on with consumer consumption and PCE and all these other factors that we got so used to paying so much attention to for the last 15 years. They're still important. We just think that they're less important now, and what is more important, what will drive returns in the real economy, are things like inflation and fiscal policy. And that's where I really encourage people to spend more of their time, more of their brain power, more of their analysis, because that's where we're going to find investment opportunities. That's how we're going to create returns. It's much less dependent on the Fed.
Yes, but the Fed still has a big impact because its interest rates are still very high. I hear more and more stories of private equity funded platforms doing fine, but that had done aggressive acquisitions over the last couple of years that have stacked on debt and are leaving some of those private equity platforms that have done these bolt-ons with high debt in a more fragile space than we'd like to see. Are you seeing some of that? And I think there's some concern, both the businesses aren't quite performing or the debt levels are too high and the debt costs are too high. Any thoughts there?
Oh, absolutely, Scott. I mean, we're we are seeing that, and there's going to be more pain in some of those sort of later vintage funds and their investments that are levered as they seek to refinance, seek to exit, and frankly, like there's just going to be a lot of exits where their sponsors are not going to make their expected returns, and they're going to have to just offload some of these companies at what one sponsor told me were highly unfortunate multiples, which I think is a pretty nice way of saying it. And because they just have to clean up some of these investments, take some painful losses as we try to focus on making investments for the future in this sort of new regime, and we've seen evidence of that anecdotally. We see evidence of that in the financial press and the financial data with the rise of continuation funds, the rise of NAV loans, some other sort of financing vehicles as sponsors try to extend lifelines to highly levered companies that they had banked on selling at 14x, call it for sake of discussion. They banked on selling them at 14x as they were building up these platforms. Now the market's only supporting 10x, and they also have an untenable leverage situation that just leaves a lot of sponsors with few options. But we think that the prudent ones, the leading ones, are managing that as best as anybody can expect, right? Because it is exceptionally tough. It's a very uncommon situation to have to try to roll this over. But it's almost like ripping the Band-Aid off, right? Getting that done, and then can focus on creating value with new investments to generate those hopefully similar returns, but generate them in a different way, not from multiple expansion, but from investing in operations and navigating this new regime.
No, that sounds exactly right. At least for the moment, the period of multiple arbitrage or winning through multiple expansion seems to be challenging, and the hope is, at some point the multiples get back to where they were. But in the meantime, if you want to grow the value of a business with a bit of a lower multiple on the exit, then you better be in a spot where that business is performing well and showing good business growth, and that's hard in a tough environment.
Yeah, absolutely. One benefit is I feel like every day, we flip the calendar over one more day, we get a little more visibility into what the future of this regime looks, right? The dust settles a little bit more every day, and that reduction in volatility, whether it's volatility around the future of monetary policy or the future of fiscal policy, the future of inflation, that certainly helps make better decisions, right? That reduces the cost of making decisions. We have better insight in there that helps support multiples, and that is generally a good thing for sponsors. Now, it doesn't look exactly that way in every ecosystem, right? There's still a lot of industries that have a lot of uncertainty around certain policy movements and things, but in general, it seems like a lot of that or some of that uncertainty kind of works itself out of the system, every day, week, month.
100%, 100%. Matt, anything else that's top of mind currently that you're looking at?
It's it really still is a lot of this conversation around interest rate, the regime change. I will say we're seeing some really exciting funds being raised by certain sponsors. Talks, maybe hopefully optimistic, maybe perhaps naively optimistic, of certain corners of the IPO market, opening soon. We're seeing and discussing with private companies and clients and sponsors that are trying to position some of their investments for an IPO, and I think that is also very exciting, kind of speaks again to this reduced uncertainty, right? It doesn't matter it matters, right? Interest rates can be high, low, that's fine. But as long as we're more certain about the future of those interest rates, we can make capital markets decisions. And we're seeing some of those come back as companies try to position themselves for exits, for IPOs, for liquidity events, whatever's going on. And that's sort of almost like spring is sprung after a long winter here in the capital markets. So something to be be optimistic about, I think. I consider myself an optimist. I know I don't often sound like that on this show, but it's something to be optimistic about, I think.
No, sooner or later, it feels like it'll move in the right direction. Obviously, we've got to figure out a way to control deficit spending. So in the long run, that leaves us fragile to these issues. It makes it harder to recover in the right way. But at the moment, sort of stagnant growth and higher inflation is no good. But hopefully that will come back to us in not too long. Matt, I want to thank you as always for joining us on the Becker Private Equity Business Podcast. Always one of the best people I speak to, one of the brightest. Thank you very much for joining us.
Thank you, Scott.